All right, this is going to be the last video before we get straight into the whole entire model. This is going to be 3 small concepts all in one video. These are super important for your learning. Today, risk concepts using volume imbalances with fair value gaps and kill zone / macro times. So, we're going to learn pretty much every single basic thing that you can learn about this model, all the concepts that you need, blah, blah, everything. Yeah. Hopefully, you have taken your notes and everything. But now, getting to the small technical parts of the model. So, most simple quickest thing right now is going to be using volume imbalances with fair value gaps. Probably what a volume imbalance is. Volume imbalance basically is going to be like a fair value gap, but it's going to be in a space between the close of a candle and the open of a new candle. I'll show you examples of it. The only way that you're going to use volume imbalances in this model, you're never going to use volume imbalance alone. You're only going to combine it with a fair value gap. So, getting right into that, so you can see, we'll do candlestick. We're going to live examples too right after this. And then it'll be something like this. Bam, bam, bam. And then we'll just do like a little one like that. And just say these are connected. Don't mind the weights on this, okay? So remember from fair value gap, weights aren't touching. Number 2 candle. Number 1's weights not touching number 3, right? This is going to be a bullish candle. What a volume imbalance is, I'm going to just change this. Delete that. What a volume imbalance is, as you can see, is the close of this bullish candle. There's a little gap between the close and the open of the next candle. That is showing extreme displacement in one direction. And the way that we're going to use this is whenever, so normally, your fair value gap would be this, right? Let me just make this clear. I'm going to extend it right. I'm going to do it, okay? This is normally your fair value gap. Wick to wick, right? Way that we use this model. Any fair value gap you're going to mark out that has a volume imbalance, super, super simple. All you do is move the candle open, okay? So now, as you can see, instead of when, if you wait for retrace to enter, instead of waiting until the original fair value gap, you're going to add the volume imbalance, and this is your new fair value gap, okay? So we'll get into examples of that later. But first, again, so also super, super important concept to be macro times. What macro time is? Basically, it's key macro windows that you were looking to trade. So this model, I'm teaching you, I only trade it between 9:50 and 10:10 your time. Okay, so obviously you're going to be on the market 9:30 open. You're going to force you to do more analysis, but you are not. This is probably one of the most important things. You are not going to take a trade unless it is inside of this 9:50 and 10:10 macro window. That is the only time that you're going to take this. Okay, only set up 10:50 or 9:50 and 10:10. Other macro times, one macro window is going to be the last 10 minutes of the hour and the first 10 minutes of the hour. Okay, these are other macro times 10:50, 11:10, 1:50, 2:10, but you're not going to trade. This model works specifically for 9:50 to 10:10 macro window. That is the only time you will be taking trades. Let me repeat this so it gets in your mind. The only time that you will be taking trades is 9:50 to 10:10. That is the only time you will enter inside a trade. Not 1 minute before, not 1 minute after. Okay, okay. Why this works? This is when institutional algorithms rebalance positions. Liquidity injection happens. The liquidity in the market runs straight to your take profit, and large moves often start here. So why we want to get in? Because that's where large moves start. Okay. So that's probably one of the most important concepts. 9:50 to 10:10, the only time that you will be entering a trade. Okay. Now, risk concepts for when you are inside of a trade. Your profit targets should be equal highs, equal lows, liquidity pools, previous day high, previous day low, opposite side of the range, or if you're targeting a new opening gap, or first presented fair value gap, or just an imbalance, you can retrace price too. For your stop loss, you're going to place it below liquidity sweeps, below the displacement candle, so the fair value gap candle, or a market structure. You're going to be risking 0.5 to 1% per trade. So if you're on a profit account, 50K account, you're going to risk $500 to $1,000. Okay, I don't know if that's math, but we'll get into proper mastery after you learn the model. But getting into a live example of this. Perfect example right here of the volume balance that you're going to use. Okay, as you can see, there's a gap right there. Volume balance, right? How you're going to mark this out? Fair value gap low plus the volume balance. Bam, that is your fair value gap. Let's look at actual. Yeah, this is market open right here. See if they're running today. Yes, right here. Okay, what do we see here? Little itty bitty volume balance. You can account for it, right? What can you see? And there's one here. So you can use both volume balance plus fair value gap, and that is going to be your fair value gap. Now, stop loss placement. Let's get an example. Okay, example right here. Sweep of liquidity equal lows. Sweep. Find your entry. Remember risk model. 0.5 to 1%. You can see your time value and then use your calculator. But you're either going to do it at the liquidity low, right? So this is liquidity low. Stop loss there. Or you can stop loss at the bottom of the fair value gap candle, the last candle of the fair value gap. So volume balance plus volume balance. Bam. Let me zoom in this section. Right? Volume balance, the bottom of the fair value gap candle 1, right? And that could be your stop placement 2. And lastly, just pools liquidity. As you can see, there's pool liquidity here. You say price goes low here, I want to trade. Bam. Those are your stop loss and your targets. So it's a quick video explaining these small concepts, but very, very important to your learning. Next video, super, super important, is going to be the actual strategy and model. Super excited to go to that, and that will be out tomorrow